Good evening, everyone. Welcome to our free webinar on 3 expert strategies to help reduce your income tax bill. My name is Paul Standwick. I'm one of the managing directors here at MLP Wealth Management. I've been here for 21 years and I'm a chartered financial planner. I'm sure some of you on the webinar this evening will know me, others maybe not. And first of all, I'd like to thank all of our clients for continuing to entrust us with their finances. We know this is a big deal, a hard decision to make. The idea of this evening is to provide you with some useful tips. The session will last approximately 45 minutes. We're going to see how things go, see how many questions we get, etc. We'll try not to overrun. Sure, you're busy and you've got things to do. Sean will be presenting on today's topic in a minute. Please can everyone make sure that their microphones are off, they're muted, and that they remain so for the duration of the webinar. The webinar is recorded and we will be sharing it with everyone afterwards. Don't worry, you won't appear on there. It will literally just be the presentation. In terms of questions, there is a Q&A function at the bottom of the screen. Hopefully you can see. So as questions arise as we're going through the webinar, if you'd like to pop them in there, that would be great. Or the chat function. We'll try and keep an eye on both, and then we'll come back at the end of the webinar and get through as many as we can. We plan to have 5-10 minutes, something like that. Depends how things pan out. Sean will also put up some contact details. So if you do have any follow-up questions, anything that you think of afterwards, or we don't get to cover during the session, please book in for a free consultation. So that's all from me for now. I'll hand over to Sean so he can take you through his presentation.
Hello and welcome to the MLP Wealth webinar. So in this we'll be covering 3 expert strategies to reduce your income tax bill. Thank you for joining us tonight. Just to briefly introduce myself for anyone who doesn't know me, I'm Sean Standwick. So I'm a chartered financial planner and I'm co-director here at MLP with Paul. So I've been at MLP Wealth for over 10 years now. In that time, we've grown from managing about 20 million of client money to over 220 million. So that's thanks to lots of our clients and lots of you on this call. Now, let's move on to the agenda for today. What we will be covering, so who we are and what we help with, just a brief bit about that. What's the problem? So let's go through this. How does income tax work? Make sure we have that foundation. Then we will go through 3 strategies to reduce the income tax. And then, we'll go through a summary and finally that Q&A. As Paul says, please do ask questions. It makes it far more interesting for everyone. It makes it interactive. No question is too silly, and someone else has probably got the same question, just not going to ask it. So who are we other than a bunch of charming people in this photo, or you may not agree with that? As a firm, we're a family run business. So we're established over 42 years ago, set up by our father, Paul and I. We're brothers, now run the business. We officially took over in June 2023. We're independent. What does this mean? It means that we're not tied to any one provider, whether that's a product provider, whether it's an investment provider, or anything to do with financial planning. This is really important to us, and it means we're always sure that we can offer you the best thing we can find you. We're also chartered. Again, what does this mean? So to be a financial planner or financial advisor, you have to be qualified, but there's a higher level of qualification that you can achieve, i.e. chartered, and both Paul and I are chartered. It's also a recognition of our years of experience. You have to be 5 years in the industry. And we're also a chartered firm, and that has other criteria we have to meet. In terms of our company goals, there are three main ones. Providing peace of mind is one, offering a vehicle for people to be successful. So this is not only our clients, of course, but also the people that work here as well. And really, the point is, it's all about shared success. So, if our clients are successful, then our people here that work are successful, the business is successful, everybody wins. We've been rated top rated, so we featured in the top 131 firms in the country, the only one in Banstead. This was all based on client reviews. Again, some of you on this call will have left a review, so thank you very much. So we featured in the guides in the Times and the Telegraph ever since their inception over 7 years ago. Something we're really proud of. We've got a very high rating on there, and it's just going to come up and explain some of the things we cover, but we will go through that a bit more later. Just to also note, we've recently just been announced that we're listed in the top 50 boutique advice firms in the country. Can't say too much about it at the moment. We will let you know about that, but it is with a well-known newspaper, and we've got high Google review ratings as well. Moving on to what's the problem. So I always try and slip this picture in because Paul hates it. He asked me earlier, why have you got this in there? But anyway, moving on, enough about us. We're here to talk about what's the problem. So taxes have been increasing over many years. Now, it's not just this government, it's been happening with previous governments too. But that is to say it did accelerate in the October 2024 budget. So it was announced that there would be 40 billion in tax rises, the biggest since 1994. Some of these have been employer NI, national insurance increases, capital gains tax, so that increases basic rate taxpayer from 10% to 18%, as a higher rate taxpayer from 20 to 24%. Inheritance tax, so that has also changed in that now that you've heard about the agricultural relief, there's been a lot of news on that, but there's also business relief. There's been a reduction. There's a cap on that. Up to 1 million gets 100% relief. Anything over that gets 50%. Stamp duty on second homes, so that's increased from 3 to 5%. VAT has been added to school fees as of January 2025. And the Office of Budget Responsibility came out and said that this would see the highest ever tax burden as a share of GDP. So what this means is that the government are going to collect more in taxes relative to how much the country is making than any previous time on record. So moving on to income tax and how it works. It's important to have this foundation before we go into too much more depth. Everyone has a personal allowance of £12,570. So any earnings, or should I say income, up to this will not be taxed. You then have your basic rate. So that's at 20% until you hit the higher rate, which kicks in at £50,270. So that's at 40%. Then you have your higher rate, and that's at 125,140, and that's at 45%. Now, what's interesting here is that the personal allowance can also be lost. So for every £1, £1 is lost for every two over £100,000. What this means is that if you do have an income of 125,140 or higher, you don't have your personal allowance anymore. And this is where it said you're equivalent to a 60% taxpayer. Now, just talking about something known as fiscal drag, don't get too bogged down in the terminology, but personal allowance and the higher rate thresholds have been frozen since April 2021, and they are due to remain so until April 2028. So not everyone is aware of the impact of allowances being frozen. When we talk about tax rises, as per previous slides, we tend to think about increases in the rates, i.e. capital gains tax amongst the other ones. But actually, when we talk about increases in taxes, it's really important to understand the impact of things being frozen by not keeping in line with inflation. So it's interesting to note if these rates had increased in line with inflation, it's estimated that the personal allowance today would be 15,400. It's quite a lot higher than what it actually is today. The higher rate threshold would be even higher, so 61,500. And then the additional rate, again, quite a lot higher than what it currently is, £153,200. So what's the result? What does this really mean? It means we're paying more tax. So what can you do about it? We've talked about the problems. It's given that foundation of how you're taxed on your income. So we're going to now go through 3 solutions. So the first one I want to talk to you about are venture capital trusts, or VCTs. So I want to kind of break that traditional mold of the things you might think about. Not everyone thinks of or knows about venture capital trusts. So how do these work? They're investments. If you invest into them, you have 30% income tax relief. Really important to note, though, it is what's known as a tax reducer. So you have to have paid the tax in order to claim it back. You can invest up to £200,000 per annum, so it's quite a lot of money. Any dividends are tax-free, and dividend taxes are another tax that have increased over the years. No capital gains tax. We covered how they've increased over years as well. Just some other points here. So there's a minimum holding period of 5 years in order to retain those tax reliefs, and they are higher risk investments, so tend to find exciting UK companies. So some successful ones are the likes of Zoopla. You may have heard of them, or you probably have, and Graze as well. Now moving on to our second solution, might not be a surprise to some of you, pension contributions. So my job today is to make this exciting. Now, when I first wrote this webinar here, Paul read it and it said, make this exciting again. And Paul said, what do you mean again? I know a lot of people don't find pensions exciting, and we do hear some people say they think they're a waste of time, they're not worth it. Hopefully after today, you'll either be a tiny bit excited or very excited, or at least see the value in them. So for some, the tax relief is actually equivalent to 60%. There's an allowance that you can put in every year, so £60,000 per annum. And you can also use potentially something called carry forward. And that's where you use previous allowances from previous tax years that you haven't used. So in some scenarios, you could contribute up to £220,000. So how does it work? I'm going to concentrate tonight, on personal pension contributions. It does work differently if you're an employer or you run a company and you contribute from your business. Probably actually more tax efficient to do it from your business. And if anyone wants to discuss that, we can discuss it separately, but I just will focus today on how it works personally. So if you put some money into a pension, the government tops it up with 20%. It's quite a lot. Now, if you're a higher rate taxpayer, you can also reclaim that further 20% in tax you pay. An additional rate taxpayers can reclaim 25%. Now, you can also potentially gain back your personal allowance. So for those people that don't have a personal allowance or lose some of it or all of it, you could potentially get it back. And that's where the effective tax saving can be seen as 60%. So just to talk you through an example and to put some numbers on the screen, hopefully it will bring it home a bit more. So if you have a relevant income of 125,000 and you contribute from your bank account personally £20,000 into a pension, the government will top up with £5,000. So that's the 20%. Now, this example we're a high rate taxpayer, so you can reclaim that further 5,000, that further 20%. And you also, in this scenario, because they've lost their personal allowance, gain back the personal allowance, which is just over £5,000, and the total tax saving therefore is £15,000 by contributing 20,000 from your bank account. So this is what I'm talking about when I say something exciting. To me, that sounds like a really, really good deal. And, you know, it's a government giveaway, really, that shouldn't be ignored. Now, pensions get a bit better than this. I've talked about how it works when you put your money in, but also when it's in there, they are 100% tax-free investment vehicles. So any growth on there won't be taxed while it sits in there as well. You also get your 25% tax-free cash when you withdraw. And then anything else will be taxed as if it's an income. So we talked about the rates previously, so that can be managed. You know, and there are some scenarios where if you haven't got any other incomes, you could, in theory, not pay any tax. You've got up to your personal allowance. You know, for a lot of people, if they're higher rate taxpayers when they're working in retirement, they may only be a basic rate. So that does make quite a bit of difference. And just to note that there are other benefits to pensions as well. So they can be an effective and a tax-efficient way of passing money on to loved ones. Just be aware that with the change in legislation that's been announced that kicks in 2027, which we covered in our previous webinar, and we're happy to discuss this, that there will now be inheritance tax due from 2027 on pensions. It's also just a common misconception that, oh, I've got a will and therefore my money and my pension will pass on smoothly to my loved ones. Well, no, you should nominate who you want your money to go with your pension provider. So enough about pensions. Let's move on to our third solution, enterprise investment schemes, or EIS. Now, if you invest into one of these, you will also receive 30% income tax relief and as a tax reducer. So again, you have to have paid the tax in order to reclaim it. And what's really interesting is you can invest up to £1 million into these per tax year, and you can actually put a further million if you're investing into knowledge intensive companies. Carryback is available, and what that means is you can use the tax relief. You can basically contribute for a year previous and get the tax relief for that year too. Capital gains tax, so this is really interesting. Gains from 1 year before the investment and 3 years after can be deferred. Now, to put this bit more perspective and bring it to life, for example, you might have an investment, you might have a second property, and when you sell those, if you make a capital gain, the point is if you reinvest it into an EIS, there wouldn't be any capital gains. It would be deferred. Now, there's just a point here as well that there's no capital gains on tax. So in theory, if you hold this upon death, there wouldn't be any capital gains tax due at that point. So you can also offset losses against your income. So that's another benefit. And these have a minimum holding period of 3 years. And another big benefit to these is after 2 years, there's no inheritance tax either. Now, again, these are high risk investments, exciting UK companies. I would put these as generally higher risk than VCTs, but some examples of some companies that have done well, Girlstow and ManyPets, a pet insurance company. So really at this point, covered most of the solutions here. I would say, you know, just get professional help with these things. It can get quite complicated, but also this is complex. The correct solution really does depend on your situation. So I also suggest speak to a financial planner to assess what's right for you based on your circumstances. This is where we can come in and we can potentially help you. So just a summary of what we've covered. We've talked about the ever increasing taxes. We've talked about how your income is taxed. Then went through the 3 solutions to reduce your income tax. So investing into VCTs, pension contributions, and investing into EIS. And then, as I said, just get professional help with these things. By the way, anything we have covered, just to say, please don't construe these as advice. It shouldn't make you take or refrain from taking any action. Just moving on, we do have lots of free content for you. We have quarterly webinars, so keep your eyes peeled for the next one. We have monthly newsletters. If you're not receiving these, please do get in contact. We can make sure you do get them. We have guides. These come out intermittently on certain topics. They're also listed on our website. We have other articles often on our website, and I post regularly on LinkedIn almost every day, on average 5 times a week, with various financial tips and also a bit about what's going on here at MLP Wealth. We've also got an Instagram account as well, so please do have a look at these places and have a look at them as the free content for you. So our next webinar, that's going to be a budget special. So that's due the budget on the 26th of November. So we'll plan to do it after that. So it'll probably be end of November, well, beginning of December, more than likely, depending on what comes out of it. So we'll just see what comes out and then we'll decide what to do it on. As I say, if you're on our mailing list already, you will be informed about it. If you're not, just get in contact. We can make sure that you're alerted to it. So just keep an eye there. As we said earlier, we're here for a chat. Can we help you? So on this screen, there are 2 QR codes. If you want to book in a call with me, there's the one on the left here. Just have a scan of that. You can book straight in. On the right, we've got Paul's QR code there. Alternatively, just take a look at our contact details down here. So there's an email address. If you just want to email and just put in the title webinar, we'll know what you want to discuss and someone will give you a call. Alternatively, just give us a call on our landline phone number. So really, then we're just on to our Q&A session. So Paul, have we had any questions that have come in? I think
there are currently no questions in either the Q&A or the chat. So, if anyone has got any, please put them in there. I've got a couple of things that I'll ask you just on the back of listening to what you've had to say. Perhaps it would be useful for the participants just to understand a little bit about how business relief works and what it actually is, because the idea of today is that we gave a quick summary of kind of reliefs that you might find useful, but I felt like perhaps people could benefit from understanding a little bit more about that. If you want to talk just for a minute or two.
Yeah, so there's been a lot in the news, hasn't there, about this agricultural relief, but it's very much interlinked with business relief. It works in a very similar way. It just qualifies for something slightly different. So if you hold something that qualifies for business relief, and now there are products that are set up for this, been running for many, many years, then if you hold it for 2 years, then it will qualify for the business relief and therefore it won't be subject to inheritance tax. So there are different offerings available. They're not often looking to maybe achieve super high returns. It's more about saving that 40% inheritance tax. Do you have any more questions on that?
We've got a question that's coming from Clive. So just to finish off on that then, so you invest in a product which contains assets that will qualify for business relief after 2 years, and then as you pointed out in the webinar, after that period, those assets up to £1 million will receive 100% income tax relief. So you pay 0 tax as long as they do qualify, and above that, it was how much tax, Sean?
Well, it gets 50% relief. So inheritance tax is at 40%, so it would just be 20% at that point.
Okay, so you could potentially invest 2 million, and the million would get 20%. So the 1 million would have no tax potentially after 2 years, and the balance would be taxed at 20%. I think also, just to add, I think you can also use a trust allowance. So it's potentially an individual can actually have 1 million in their personal name and 1 million in trust as well. So
just to add to that, sorry, can I just add? So therefore, each person can have 2 million between a couple. That's 4 million, right?
Yeah. So Clive, great question from you, and I had actually made a couple of notes in case we didn't get many questions, and yours is very much in line with my next question I was going to ask. So I'll read out what Clive's written first of all. Do you have to select a company to invest in VCTs or EISs, or do you have to trust that? Do you have it invest in a trust that spreads the risk? And if so, how do you select the best one for you? So how my very much similar to my question, which I'd written down, which was how do VCTs operate in terms of spreading the risk and choosing the companies that they invest in to achieve those reliefs? Because of course, the whole idea of VCTs is they have tax incentives to encourage people to invest in early stage companies. So how does that work?
Yeah, so you don't have to select the individual companies. So for example, the ones we wouldn't recommend investing in one company. What you do is you invest in a portfolio of companies, and as you say, to spread the risk. So what we do is we do in-depth research to find, first of all, VCTs are not always open, so they're not like other investments you can just invest in at any period. They have what we call allotments, and so there's certain periods and times in the year where you can invest into them. And depending on the type of VCT, they might have 50 companies, they might have 100, 150, 200 underlying companies. Often what you find is the companies that run these portfolios actually sit on the boards of these companies and they advise them, and they've got a lot of experience in these type of companies in terms of their sectors, in terms of their sizes, and having successors. So the really successful ones end up either going to market or selling out to a bigger company. So yeah, absolutely. We do our research to offer really portfolios of these VCTs according to what's suitable for you.
Yeah, just to add on to what Sean has said, I think the way that most of these VCTs are run is they will have an investment team. Each VCT will have a strategy, a mandate by which it invests, whether that be something like early stage tech companies or slightly more mature companies with established revenue streams. And then the specialists who work on the VCT will help the companies that they invest in, which you, by virtue of putting money in the VCT, will also help fund. And they will have expertise in those areas typically and help them grow. In addition to that, what they will do is help the companies when they want to exit. So they often have good relationship. Let's go back to the tech example. People who are running the VCT, the specialists, they will have good relationships with companies such as Microsoft, etc., who will typically buy out these early stage companies when it comes to time for them to monetize the growth, the performance of the companies. That's how they can also add value. Darren's just asked a quick question. Is the webinar recorded? Yes, Darren, it is. So no worries. We'll send it round to everyone who's attended. No problems there. We still haven't got any other. Oh wait, there might be. No, sorry, we haven't got any other questions right now. I'll just ask one more on behalf of everyone else, and then unless we get any others through, you're all free to leave. And that was it. Sean, could you just touch on the spousal? Obviously, there's this situation that we've got unfolding at the moment where pensions are due to be brought into the estate April 2027. But we're waiting for a little bit more detail on exactly how it's going to happen, and we'll be informing our clients in due course. It's going to be very, very tricky. but as most of us realise, there is no inheritance tax uh, between husband and wife. There's what we call a spousal exemption. So do you want to talk a little bit about how that can be a very efficient way of passing money on, Sean, within a pension?
Yeah, so when I mentioned it's important to nominate people on your pension, what you want to be able to do is pass the money on within the pension to, well, it can be whoever you want. So it actually doesn't need to be a spouse, but if you're talking specifically about a spouse, your spouse can inherit that pension or anybody. And at this point, it does bypass the estate. So there's no inheritance tax due on that. Um, Now, in terms of spousal exemption, so when that does kick in 2027 inheritance tax, well, there wouldn't be any inheritance tax at that stage. So when that does kick in, yes, on a first basis, you probably, depends on your circumstances, but for a lot of people, it would make sense to leave it to your spouse, because then at least at that point there's no inheritance tax due, and then you can maybe do some planning elsewhere to hopefully reduce or maybe mitigate the inheritance tax.
Yeah, I mean, I think it's worth mentioning as well. So, whilst pensions, might not look so good from an IHT perspective post 2027, assuming the changes come in and remain in force that are being proposed, that if you do pass it to your husband and wife, or um, husband or wife, they will still be able to access the pension and potentially on death before 75, tax free. So you would have in that instance, you would be able to pass on a pension to your spouse, and they would be able to maintain the investments as long as it was set up correctly. You have to have the right functionality, and you obviously not all pensions do. So it's very important that's checked, and like Sean said, very important the death beneficiaries are set up correctly. But they would be able to maintain a very tax efficient investment with no CGT, no dividend tax, and potentially access that tax free if the person who passed it on had died before 75, and if they hadn't, it would be subject to income tax. Just one more question from Clive before we go. I'm currently reducing my tax bill via extra contributions into my pension via my employer. But should I think about moving that into I think that's a VCT you meant there, Clive, as that was your number one, as that was number one in your presentation?
Yeah, so I can't really answer that without knowing your circumstances. So I don't know how much you're contributing in there and what your tax situation is. All I can say is that pensions are extremely tax efficient, as I went through and my sort of thing about making them exciting. Um, and as we said, at this point, there are an efficient way of passing money on to families. So there are many, many benefits. We're sticking on the income tax piece. They're very, very tax efficient. And the difference between a pension and a VCT is that you don't need to have such a high risk investment. So you can have a much more diversified, lower risk portfolio. Whereas with a VCT, it's going to be higher risk. I wouldn't say don't contribute into a pension. It depends whether you've got more money that you want to invest, probably. And if you have more and you want to get more tax relief, then that's where you might want to think about it. But again, I can't sort of advise that here. I need to assess your situation. But
I mean,
hopefully that kind of,
I can add a couple of bits on to that. One thing it's important to remember for any individual who's either a higher or additional rate taxpayer, via a pension that would allow up to 45% tax relief. A VCT does not. The
yeah.
VCT is
So
30% income tax relief. The fact that Sean put it at the beginning of the presentation was neither here nor there. It's not that that was the best and then second best and third best. That's not what it was about. It was just trying to give you information. The second thing to mention is that both VCTs and EISs are seen as satellite holdings. What does that mean? It means that normally when people have a well-funded pension and they've used most of their allowances or all of their allowances in cases, and their ISA allowances as well. That's something we haven't really touched on today, but also another tax efficient vehicle. They then tend to use things like some people tend to use VCTs, EISs as small holdings around the edge to offer further tax relief. Now, some people are more aggressive with them than others, but I think the short answer, if we're going to generalize, is that these are higher risk and they shouldn't be seen for the bulk of your retirement savings. That's what your pension is for. These are a bonus scheme that you can hold to the side for people who are. There's other situations. So, for example, some higher earners they're tapered on their pension contributions and they can't contribute £60,000 per year. That's another increase in taxation, if you like, that we've seen. So for people like that, they're particularly interesting. And again, people who have fully funded their pensions and ISAs. That's a general answer, but Sean's quite right. That's a discussion, Clive, that you need to have with someone like me or James. I know you've been talking to James over the last year or two when you next speak with him. So yeah. Okay. We'll just give it another 20 seconds in case there's any other questions come through. But assuming they don't, I'd just like to say, thank you for everyone for attending tonight. Please, if anything else comes up, please do get in touch. Sean put up the QR codes, but I'm sure a lot of you will have our contact details anyway. The office telephone number is 0208 296 1799. And a lot of you have our email addresses. We do have an info at one as well, info@mlpwealth.co.uk. We're always available to speak to anyone should they need anything. So I think we will bring it to an end there. Thank you again. Have a lovely evening, and thank you to Sean for presenting.
Thank you, everybody.
Cheers. Bye.